We all make mistakes, but when it comes to your money, those errors could cost you. Investing requires research, balance, and reasoned decisions to be successful over the long term. Keeping your eyes open for these common investing mistakes can help you avoid costly mistakes and improve your overall investment process. 1. Not having a plan. When investing, you need to develop a plan and stick to it. This will help you avoid impulsive decisions that may result in losses. Investors should make decisions based on research and a clear understanding of their goals and the risks associated with each investment option. They should also be aware of their own risk tolerance and diversify their portfolio to reduce the risk of losing capital. One of the biggest mistakes people make is jumping on the latest investment craze or following market fads without a thorough understanding of the company and its financials. This is a form of FOMO, fear of missing out, which can lead to poor decision-making and loss of money. Investing requires patience and discipline, so it is important to avoid making impulsive decisions that could affect your long-term goals. Another mistake investors often make is over-concentrating their portfolio in a single industry or asset class. This can lead to excessive risk and reduced returns. Instead, it is best to diversify your investments across different industries, assets, and countries. This will help you reduce your exposure to risk and increase your chances of success. In addition, it is crucial to set up a budget and stick to it. This will ensure that you are saving regularly and allowing time to work its magic on your portfolio. 2. Not having a long-term goal. Investing may be a great way to reach your financial goals, but it is not always an easy process. Many people make mistakes along the way, which can lead to poor returns and even losses. Fortunately, most of these mistakes are avoidable. One of the most common mistakes that investors make is not having a long-term goal when investing. This can lead to a lack of consistency and a skewed view of your portfolio's performance. It can also cause you to become emotional and to make rash decisions. For example, you might get caught up in a market dip and sell your investments when prices are low. Or you might try to time the market, which is a strategy that often backfires. Instead, you should have a clear idea of what your investing goals are and how much risk you are comfortable taking. This will help you choose the right investments for your needs and ensure that your portfolio is diversified. It will also keep you from making rash decisions based on emotions or the latest investment fad. Instead, you will be able to focus on your long-term investment goals and stick with them. This will help you avoid making costly investing mistakes. 3. Not having a good understanding of the market. Investing is a long-term process that requires discipline and patience. However, many people often make mistakes that can lead to financial disaster. These mistakes may include emotional decision-making, making decisions based on emotions like fear or greed, lack of research, not conducting enough due diligence to understand an investment before investing, herd mentality, jumping on the bandwagon of a new fad or trend without doing your own research, trying to time the market, attempting to predict short-term market movements, and missing out on potential returns. Having a good understanding of the market is essential for investors, as it allows them to make informed decisions that will help them achieve their financial goals. This includes knowing how much risk they are willing to take and analyzing an investment's fundamentals. It also means avoiding costly investment mistakes, such as not diversifying your portfolio or paying high fees. Regardless of your level of knowledge, it's important to avoid these common mistakes when investing so that you can improve your chances of achieving your financial goals. By following these simple tips, you can avoid the most common investing mistakes and become a better investor. Remember, it's not just about what you earn, it's about what you keep. Chapter 4. Not having a good understanding of risk. Investing is an excellent way to grow your wealth, but it does come with some risk. It's important to understand the risks involved so that you can make informed decisions about your investments. One of the most common mistakes investors make is making emotional or impulsive decisions. This can be caused by fear, greed, or panic. It can also be the result of not having a clear plan or failing to stay focused on their financial goals. Another mistake investors often make is investing in things they don't understand. This can be the result of not doing enough research or following market fads. For example, many investors became involved in cryptocurrencies after hearing about the amazing returns they had received. This was a result of not understanding the risk associated with these investments and the fact that they were speculative in nature. There are also other risks that investors should be aware of, such as the possibility that their investment will decline in value due to economic or political events. It's also important to consider the potential impact of inflation, which can decrease the purchasing power of your investment over time. Finally, it's important to diversify your portfolio so that you aren't exposed to too much risk. 5. Not having a good understanding of fees. Having a good understanding of the fees associated with investing is a must. Fees can significantly reduce the returns on your investment. Not knowing what you are paying for is a common mistake. Some fees are required and cannot be avoided, while others can be minimized. It is important to understand the different fees that are charged by your broker and advisor. You can find this information by asking your advisor or reading the fine print on your statements. It is also important to be aware of the fees that are charged by the company you are investing in. This includes management fees, transaction fees, and taxes. Having a good understanding of these fees can help you make better decisions about where to invest your money. Finally, it is important to avoid making emotional decisions when investing. Emotional reactions to market fluctuations can lead to impulsive investments that could derail your financial goals. It is also important to remember that investing is a long-term endeavor and that it is not possible to guarantee profits. By avoiding these mistakes, you can increase your chances of successfully meeting your financial goals. Chapter 6. Not having a good understanding of investments. Investing can seem like a minefield. Even seasoned investors often make mistakes, and one wrong step can ruin your portfolio. Fortunately, understanding the most common investing mistakes can help you avoid them. Emotional decision-making. Investing on the basis of fear or greed can lead to impulsive choices that don't align with your long-term goals. Try to stay calm and rational when making decisions. Lack of research. Failing to thoroughly research the companies or asset classes you're considering can lead to poor investment decisions. It's important to understand the underlying business models of your investments. Over-concentration, putting too much of your money into a single investment or asset class, can expose you to unnecessary risk. You should always diversify your portfolio across different sectors and asset types. Market timing. Trying to predict short-term market movements can be a costly mistake. Market swings can be based on complex variables, news, and investor sentiment. Missing just a few of the best days in the market can dramatically reduce your returns. Letting your emotions dictate your decisions. Jumping on the bandwagon of the latest investment craze can be dangerous and ultimately lead to regret. For example, investing too heavily in tech stocks can make you susceptible to a collapse of the sector, which could be very costly. Chapter 7. Not having a good understanding of investing. Investing is a long-term process to achieve your financial goals. However, many investors make mistakes which can jeopardize their future wealth. This can be due to a lack of knowledge about investing or because they are making technical process mistakes. Technical process mistakes are errors in the way you implement your investment strategy. They can include ignoring fees and costs or failing to properly diversify your portfolio. Another mistake people make is buying stocks simply because they are popular, which can lead to overvaluation and investing in bubbles. Instead, you should always make your own analysis of a company before deciding to invest. It is also important to stay up to date on industry news and to learn as much as you can about the basics of investing. Finally, it is a common mistake to invest in assets that are too risky for your risk tolerance. For example, if you are a risk-averse investor, it may be a bad idea to invest in tech stocks. Additionally, it is important to be aware of interest rate risk. The price of bonds is inversely related to interest rates, so if rates rise, bond prices will decline. This is a good reason to diversify your portfolio and invest in assets with different correlations to stocks.